Okay, welcome everyone to the carbon market outlook for 2023 from TEM. My name is Adrian Enright and I'm the CEO of TEM Corporate. I have the pleasure of hosting you alongside of Georgia, who I'll get to introduce in one moment. I'm based here in Sydney in Dharawal country, and last night it was beautifully rainy, and waking up this morning to walk to the train station and smelling the fresh crisp air of the surrounding forest was a real pleasure, and it reminded me of the custodianship of our traditional owners and how they've taken care of the land in which I live for the last tens of thousands of years. And on that note, I would like to pay my respects to their elders, past, present, and emerging, and acknowledging the Dharawal country from where I'm coming to you from. And I would also encourage you to all briefly reflect on the land in which you are residing, and that goes for our Australian counterparts, but also equally for the large number of international contingent that we've got joining the call as well. Today, our intent is to cover off on two key areas. Firstly, we would like to provide some analysis on some important recent changes in the Australian carbon market and reflect upon some of the key trends that we're likely to see in 2023 off the back of that. Similarly, I'll then take the reins from Georgia and speak to some of the key trends that we're likely to see in 2023. Many of the foundations were set for those in 2022. Just to note that this webinar is being recorded, and we're doing that for the purposes of being able to allow people to watch it again, but also share. It will be published on our website, which Jack will put into the chat shortly, alongside of the contacts for both Georgia and I, in case anyone has any follow-up questions, in particular on anything that we've mentioned. For those playing at home, I would encourage you to put questions into the chat, into the Q&A box. They'll come through to Georgia and I, and we'll monitor those as we go. The format in which we will run this webinar is that Georgia in a moment will take the first 10 to 15 minutes to cover off the domestic landscape here in Australia, and then I'll do the same for the international market. Following that, we'll then open the floor to about 30 minutes of Q&A before finishing up, just flagging an opportunity that many on this call may be interested in to be able to manage forward procurement and risk that exists in both key markets. With that in mind, I'll take the opportunity now to hand over to my colleague Georgia to take us through some of the recent changes in the Australian market. Georgia, over to you.
Thank you, Adrian. Great to be joining you here today. I'm joining from the land of the Wurundjeri people of the Kulin Nation. And I'm joining today to give a bit of an insight in an overview of the recent policy developments that have happened in the Australian market over the last 2 weeks. It's been a busy 2 weeks, and to seek to provide a little bit of insight into what's happened since then and what we expect might happen, might play out over the sort of coming year. 2023 has certainly kicked off to be a very exciting year. I think a few of us feel like we're in need of a holiday already, only a few weeks into the year. We've had two new exciting and quite important policy developments just in the last 2 weeks, which I'll speak to. So firstly, the Chubb review, which was the independent review into the integrity of the ACCU market, was released just over 2 weeks ago. And in addition to that, we've had the proposed reforms to the safeguard mechanism come out as well in the last 2 weeks. And combined, these two policy developments signal a new era for Australia's decarbonisation efforts. As some have said, over the last few weeks, we've actually never had more favourable climate policy settings in Australia's history. So all of this results in a very active and dynamic market for the ACCU market, and we're expecting a very bullish outlook over the next sort of year and into the next decade as well. So firstly, I'll kick off with, providing a little bit more detail into the Chubb review findings. And I've got some information on the slides here as well to support. Adrian, can you just confirm you can see that okay?
Yes, thanks, Georgia. Perfect.
Fantastic. So what the Chubb review really has found is that, or what it's given is a vote of confidence in the ACCU market in Australia. The review was undertaken, led by one of Australia's previous chief scientists, Professor Ian Chubb, and it was undertaken over quite a period of time last year. And it incorporated quite a lot of industry consultation with various sort of stakeholders in the market. And the key message that I really want to articulate today that the Chubb review found was that the ACCU market is underpinned by integrity. It found the market and the scheme to be fundamentally sound. And it looked into a number of key sort of topics or themes. And these were, broadly speaking, the governance of the scheme, a number of methodologies within the scheme, positive and negative impacts from carbon projects, as well as climate active. And it provided 16 recommendations to the federal government, which the government has since endorsed in principle. And now it's probably only a matter of time until those recommendations are enacted, but noting that they will sort of still require further consultation with the industry in terms of how they're actually enforced. And I won't speak to all of those 16 recommendations, but I'll provide a little bit of an overview of the ones that we think are particularly important to our clients and to the audience here today. So I might actually kick off with the very last recommendation, which is around climate active. I know that we have a number of climate active participants, members on the call here today, and a number of you will already be aware of the recommendation around climate active. And the recommendation was that the climate active program should not mandate any sort of minimum requirement for climate active participants to procure a certain amount of ACCUs in order to be certified as climate active. And that was quite a long-awaited, highly anticipated outcome. Other key recommendations include, with relation to governance, importantly, that the integrity of ACCU methods be assured by a new committee to be stood up to be known as the Carbon Abatement Integrity Committee. And this is subject to parliamentary process, so it would require legislative changes. So we don't expect that to come into effect immediately, but sometime over the course of this year. And secondly, on governance, that the monitoring, enforcement and compliance of the scheme, as well as ensuring the transparency of the ACCU scheme, should be administered and regulated by the Clean Energy Regulator, the CER. Importantly, here under this theme as well, the review recommended that legislation should actually be amended to allow for more transparency of the scheme, to allow for better data access with relation to things like how key decisions are made in how the scheme is governed. And then moving on to another quite important topic, which was highly anticipated with relation to project methodologies. The independent review looked into a number of quite popular methods under the ACCU framework, and it found in general that improved additional transparency around ACCU projects would really improve sort of public support for and credibility in the scheme. This includes, for example, that audit reports from individual projects should be made publicly available. Now, again, this is another recommendation that will be subject to legislative changes, so we'll wait and see how that one plays out. But we're broadly quite supportive of that because any increase in transparency in the scheme is obviously a good thing moving forward. It also made a number of recommendations with relation to human-induced regeneration projects, and this is broadly speaking that project proponents of human-induced regeneration projects would have increased requirements regarding how they sort of disclose their project activities, and that some of that would be disclosed and made publicly available on the project register. And those projects, human-induced regeneration projects, new and existing, would be required to meet those, fulfill those obligations in order to receive any ACCUs moving forward. So that's quite an important development. Again, this is all subject to whether or not the recommendations are actually enacted in the coming months. Regarding avoided deforestation projects, the review recommended that a new methodology should be stood up. So any new avoided deforestation projects would be required to be undertaken under a new methodology, and that methodology has not yet been established. So that would effectively sunset the current avoided deforestation methodology effective immediately. And then lastly here, that landfill gas projects, the crediting arrangements should be adjusted to essentially be made more stringent to match other regulatory requirements. And this would effectively see less and less supply of landfill gas ACCUs into the future. Also, I haven't included here, but another sort of topic that the Chubb review looked into in detail was potential for adverse impacts from carbon abatement from carbon projects. And it found that there's actually room for some adverse impacts and recommended a number of ways forward to address this. And this included, for example, regulating carbon service providers. So that would include organizations like TEM, brokers and traders in the market, project developers, aggregators, etc. And we see this as a broadly a positive step for the market. Probably one of the most important recommendations from the review was in relation to conditional registration of projects. Now, a lot of people probably aren't familiar with how this works, but the review recommended that project proponents should not be able to register a carbon project conditionally without the consent from the relevant native title holders. And this is extremely important, of course, from a human rights perspective and to align the scheme with principles of free, prior and informed consent. So we're definitely very supportive of this. It also recommended that action should be taken to ensure and encourage greater First Nations participation and engagement within the scheme. So all of this provides a really positive outlook for the ACCU market. It provides a way forward to strengthen the scheme's governance and increase the transparency and credibility of the scheme. And this is particularly important as Australia ramps up its decarbonisation efforts, which, as we know, it's currently doing at significant pace. So that brings me to the second key policy change. In addition to the Chubb review, Australia's decarbonisation trajectory has moved one step closer to being solidified now through the proposed safeguard mechanism reforms. So these as well have been quite highly anticipated over the last sort of year or more, and they would provide a really strong decarbonisation signal. These are subject to legislative changes, so we expect that and we hope that they would be passed, the new safeguard mechanism crediting bill would be passed through Parliament in March, with the changes enacted in April and coming to effect from the next financial year. And broadly speaking, what the changes would do, they would put the safeguard, the facilities that sit within the safeguard mechanism on a decline trajectory of 4.9% per year out to 2030. So as you can see here, it is quite a steep trajectory, going from about 143 million tonnes in this financial year to under 100 million tonnes in 2030. Other key design features to be aware of of the safeguard reforms include the proposal to introduce a cost containment reserve. I can speak to this in further detail if it comes up in questions, but essentially that would create a pool of ACCUs to be accessed by safeguard compliance facilities at a set price. Safeguard facilities would be able to use ACCUs to offset their liabilities, and there's no, the proposal is that there's no sort of limitation in terms of the use of those, and no restrictions on ACCU vintages either. So as you can imagine, these are some like direct flow-on effects to the voluntary market that we can discuss in more detail as well. And just in the last 2 weeks, we've seen these effects take place from these two policy developments. We've seen a 15% increase in the ACCU spot price. We've seen volumes traded at new records. We've seen unit holdings also at new records. Price stratification continues, and I think, Adrian, you'll speak to that as well, because that's a particularly important area to watch. And the changing credit supply dynamics. So these are resulting from some of the recommendations from the Chubb review, which I alluded to earlier. And all of this, of course, provides quite a dynamic market in terms of our outlook moving forward for 2023 and beyond. And it's important to note that these factors impacting ACCU prices are quite dynamic and they're quickly evolving. So I've included here, a brief summary of some of those. So including upward price considerations of, the safeguard mechanism compliance demand increasing, as you've seen, growing voluntary demand, supply constraints due to tightening of methods. There is a lag time for new methods to become available, and there's a lag time for credit issuance as well within the scheme. We're hearing rumours of significantly increased speculative buying in the market, which puts pressures on the supply of ACCUs. On the liquidity of ACCUs. And then as well, one thing to be aware of, so within the next 2 years, the Australian government, whichever government might be in force at that time, is expected to announce a new NDC, Nationally Determined Contribution, out to 2035. And it's expected that would steepen Australia's decarbonisation trajectory as well. And of course, there are a number of downward price considerations that might also influence the market. There's a potential continuation of the fixed CAC exit initiative, which would continue to see supply come into the market at greater pace. And we can delve into that as well as the changes to projected demand stemming from climate active participants. So this relates to the Chubb review recommendation regarding climate active, which I mentioned earlier. And so all of this, as I said, it creates a really dynamic and quickly evolving market in Australia, but we're also seeing an evolving market in internationally, aren't we, Adrian? I'll hand over to you.
Yeah, thanks a lot, Georgia, and I appreciate the segue, and I'll touch on some of the key trends that we're watching out for and that we believe will shape the market in 2023, and finish off with a couple of key procurement strategies that many organisations are putting in place, in particular to manage some of that movement that we're seeing in the ACCU price, which we anticipate to continue, but also to manage some of their international portfolio as well. So I'll touch on that at the end. So when we have a look at the international voluntary market, what has shaped it and what's likely to shape it going forward into 2023. The first point that I'd make is that in 2022, we really saw this shift into a preference for nature-based offsets, in particular things like REDD Plus and reforestation activities. That we foresee going forward only to strengthen, particularly when you have a look at the number of the increased amount of interest in nature-based projects from nature-based disclosure requirements, in particular the TNFD. So what we're starting to see are organisations looking at their carbon offset purchases not only as an opportunity to meet their carbon neutral or their 2030 targets, but actually aligning those investments with broader nature-based targets, which are starting to develop, mostly on a voluntary basis. But you can start to see that will start to become more and more of a focus in for organisations from a compliance perspective, in the same way that carbon emissions reporting has done so. So I think that's really keen, really one to watch, and probably something that's very topical at the moment. Many may have seen a lot of media in the recent couple of days around REDD+ in particular. In particular, there were claims that up to 90% of REDD+ projects are illegitimate under the Verra standard. That Verra is the largest supplier into the international voluntary market. I think I'd make a couple of points on that. First of all, there's a couple of really key and very informative responses from Verra and others in the market, which really push back against some of the scientific analysis that was called on to make those statements. But I think regardless of that, it really draws attention to the absolutely critical and non-negotiable role that due diligence plays on your carbon offset portfolio. That's something that we take really seriously at TEM, and make sure that we really respect the fact that in purchasing offsets, whether they be nature-based offsets or otherwise, you're representing the company's brand, and the integrity of those offsets do feed into the brand. So having that built in, that consideration built into your organisation's procurement strategy is absolutely critical now, and particularly, as I said, as we see the focus on nature-based preferences increase and likely to increase into 2023, I think we'll also see the scrutiny on that side of the market increasing. And the scrutiny from our perspective is certainly welcomed. We just need to make sure that that's done with sound science backing it up. And as I said, making sure that the due diligence processes involved in those procurements are watertight. Something that Georgia alluded to in the Australian market that's really true of the international market is the increased stratification of the market. So, and I think this really became apparent through a shift in corporate organisations' buying preferences towards almost a fixation on wanting to buy carbon removal projects over and above avoidance projects. So removals are sequestration projects like forestry and REDD+ avoidance would be more your large scale renewable energy technologies, right the way through to things like clean cook stoves. So this fixation on that in the market drove a really large price differential between those very broad categories, in the order of removals projects were in the order of 2 to 3 times that of avoidance projects. I think we'll continue to see that stratification over time. At the same time, I think it's important for organisations, whilst that price stratification is there and may even stretch out further, to really come to the realisation that your offset procurement strategy should be built on a range of different factors around, geography, integrity, nature, etc. And essentially, if we're going to meet the Paris targets, we're going to need both removals and avoidance. So both broad methodologies play a really key role going forward in the marketplace. As Georgia mentioned as well, that stratification is really true of the Australian market. You've got probably in the order of $10 to $15 per tonne price difference across various ACCUs. That's now stretching out even further. So, with some of the lower co-benefit methods like your landfill gas are still probably sitting at the mid 30s to high 30s now mark, right the way through to the projects like environmental plantings, which are much more scarce on the ground and generally have more co-benefits associated with them, pushing into prices above $70 a tonne. So there's a huge stratification in the market, and that's even starting to play out within methods as well. Again, to use an Australian example, human-induced regeneration projects, they can be 25-year permanents or 100-year permanents, and there's a mix of those in the market. Again, there's a stratification happening at the moment. We're observing $2 to $3 stratification between 25-year permanents versus 100-year permanents, and that's also something to consider and to watch going forward. I think really briefly, technology is going to continue to play a really interesting role in 2023, and we're going to start to see some more interesting partnerships emerge, like the World Bank's Climate Action Data Trust. That's a partnership between the World Bank, IETA, and the Singapore government. And that's really looking at open source, developing an open source meta platform to aggregate data across various carbon registries to make it much more simple and transparent for people to be able to find projects, track them more accurately, and there's ways in which they believe it will also help things like issues around double counting. So those sorts of technology plays alongside of the cryptocurrencies and blockchain technologies will no doubt play a big part in the market and the market fabric overall. Georgia, I'll just get you to skip on to the next. Thank you. In terms of, again, mirroring what Georgia was mentioning about some of the key things to watch on pricing, and I would caveat this by saying that we're talking about a very, very large, very diverse marketplace that largely remained fairly soggy and fairly soft throughout 2022, largely because of broader macroeconomic factors were relatively unfavourable. But I think there was also suppressing that, particularly at the back end of last year, was there's still some overhang in terms of Article 6 and getting clarity on some of the rules, particularly around how international units will feed into both domestic compliance, but also international voluntary commitments as well, is still keeping some of that activity in the marketplace relatively suppressed. That said, as we always like to remind people that the long-term picture and the broader dynamics hasn't changed. And that graph on the right-hand side from McKinsey, many may have seen it before, really sums it up. The carbon markets more broadly have got to grow in the order of 15 times where it is at the moment by 2030, and another 200 times by 2050 to be able to stay on track towards the Paris targets. So there's a huge amount of demand there that's still got to come through. And some of that is reflected in some of the predictions in 2023, where some are expecting in the order of a 20% increase in the number of offsets retired by businesses as part of their net zero targets. Obviously, alongside of that, more supply is anticipated to come into the market, especially as we're seeing some of those larger RED Plus projects, which started to become registered off the back of some heavier market activity around 2020 and 2021, starting to come online over the next couple of years. So what does that all point to in terms of what does it mean for an organisation's procurement of carbon offsets? And I think it means several things, but we've tried to narrow it down into 4 common approaches that we're certainly seeing in the marketplace for organisations to manage that forward risk that is in the market, as part of a much broader recognition that carbon offsets play a critical and complementary role in almost every single organisation globally, their carbon neutral or 2030 or 2050 targets. Firstly, the most common approach has been spot transactions for immediate requirements. As Georgia noted with the Australian market, you're at the will of day-to-day price movements, and even in the last week in the ACCU market, that's shifted 15%. the movement in the international market hasn't been quite as aggressive yet, and some speculators are saying that the international market has probably bottomed out in a lot of respects in terms of where pricing is at. So we can anticipate some movement there. But again, the spot transaction's one of the most common forms, but you are at that vulnerability of the price moving. And therefore, we're seeing actually more organisations shift into that second approach there and looking at multiple year forward contracts, particularly as they ramp up their offset procurement going into 2030. A really common sort of question that we get, is, well, I don't actually know what our trajectory is going forward for our organisations, and how are we meant to take forward positions. Again, a common strategy that we're seeing here is that organisations are looking at a certain percentage of what they know, let's say 20, 30% of what they foresee their requirements are going forward, and they're hedging that against a 3 to 5 year forward agreement to be able to at least cover part of that risk going forward. Again, it's a really important strategy, not only from price and supply risk management, but it also allows organisations to build deeper relationships with the projects themselves. I think that's becoming really, really critical as organisations start to talk about the benefits above and beyond what carbon projects deliver, which is really significant. Moving on to the third option there, which is really mostly for larger emitters, and it's an extension of that second part, but some organisations are starting to move into 10 to 15 year forward agreements, again, to better get a coverage of that spread of risk going forward. It's more common in that will come into play, particularly for compliance organisations, both here in Australia, but also as in particular, a lot of Asian market emission trading schemes start to firm up and people get better visibility of what their requirements are going forward. The fourth option there is, thanks, Georgia, sorry, I will wrap up. You're nudging me there nicely. Thank you. The fourth option there is what we're starting to see organisations looking at direct project investment. That can often come with built-in options, forward options against pricing. It can look at actually agreeing on forward strips of volumes going forward into later years, or in some cases outright ownership. And again, we've seen a lot of activity over the last couple of years in some of the markets across the Asia Pacific region, whereby large requirements of carbon volume, or organisations with large volumes actually looking to buy out whole projects or whole companies to be able to secure that volume. So I'll use that as a way to wrap up, and I see we've got a couple of questions coming in already, and I'd encourage people, if they haven't asked a question yet, that they do want to ask, to please pop it in the chat, and we're starting to filter that through. But I guess the key message from both a domestic side and international side is that, particularly here in Australia, the market is moving quite fast, and I'd encourage people to have a look at their procurement strategies sooner rather than later. The international market is also, the long-term prospects are very solid, and I would again sort of encourage you to think about what your international requirements are alongside of other markets like the ACCU market as well. And there were some common strategies that we've got on the table. I think I'll jump into questions now, and there is a question around the new landfill gas methodology resulting in lower certificate creation for landfill gas projects. So what do we see there in terms of supply going forward from landfill gas, and also what do we anticipate in terms of new methodologies for HIR and avoided deforestation? So for those newer to the ACCU market, landfill gas and human-induced regeneration are two of the big dominant sources, and as Georgia mentioned, there were changes to those both, as well as the avoided deforestation method. I might have a quick go at that, and Georgia, feel free to jump in. But we certainly anticipate that, given the changes, the supply from landfill gas will start to will obviously get smaller going forward because of the changes to the method and crediting periods going forward. That's going to have important supply impacts on the market because landfill gas has been a really dominant source of offsets, particularly for lower cost compliance options as well for organisations that fall under the safeguard mechanism. On HAR, I think, again, and there's parallels here with the international nature-based market, whereby the changes there were really to recognise that there was a bit of opaqueness in the market, and the changes to HIR really make sure that there's more visibility and transparency on the method. Going forward, I think it's fair to say that, a lot of people are saying that the HIR method is starting to max out here in Australia, whereby if you have a look at the availability of land still that available for human-induced regeneration, we're starting to get at the tipping point, and registrations will start to fall away. That's not to say that HIR won't still play a really key role in terms of supplying ACCUs into the market over the next into and probably a little bit beyond 2030, but we will start to see that supply from new projects start to peter out. Again, the avoided deforestation question, I mean, we anticipate there that obviously because of the limits now put on avoided deforestation and the likely pause there, we will see those availability from those particular projects slowing up as well. Georgia, I don't know if you wanted to add anything there too.
I would agree with that. Just on that picking up on that last comment around avoided deforestation, definitely, as I mentioned, that it was recommended that the current avoided deforestation method be essentially sunsetted, and it would be a matter of time before a new methodology would be proposed. But historically, that can take up to a year or so to create a new methodology, and then to implement it, you might need to implement pilot projects to test it out, etc. So we don't really have an understanding yet of how that methodology would actually take effect in terms of coming back to your question about the expected sort of abatement yield from those types of projects. On the HIR, the proposed changes for the HIR methodology, those methods rather are still in force. It's not being recommended that they be sort of cancelled or sunsetted, but rather that the project proponents have a bit more sort of reporting obligations, really. So that, in terms of the burden that would create on project proponents, we're yet to see what the extent of that would be, because the implementation of the recommendations is still yet to be sort of discussed. And once we have a greater picture of what those requirements would be and what they would entail, we'll be able to sort of understand a little bit more if there's going to be a significant lag time for issuances of HIR ACCUs to continue. Thanks, Adrian.
Thanks, Georgia. There's a lot of questions coming through, so thank you, and encourage you to keep them going. There's one more question on the ACCU market, then I might take two on the international side. The question comes around what type of projects, well, the liquidity more broadly on 10 to 15 year forward strips of projects here in Australia, and what type of projects are typically offering these long-term strips. I think I'd probably make the broad point that it's yet to be seen. We're going to see a lot more clarity on what's going to be able to be offered going forward in terms of longer term strips. They're more likely to come from the larger projects like human-induced regeneration, and to an extent maybe savanna burning activities, which is also a big point. I think at the moment that liquidity is fairly tight. However, the big question mark is how much supply we'll see come into the Australian market as organisations potentially break their fixed government contracts and put them into the voluntary market. So I would say that they're the sort of most common methods, and to a degree environmental plantings will also be able to do that. However, they're much longer term and more expensive projects to put in place, but they do have offer those longer term strips, but they're, as I said, they're probably a few years out in terms of coming to market. And it is worth considering that, yeah, we've still got a little bit of uncertainty around the supply balance and the liquidity based on a watch and see, particularly around the middle of this year and the back end of this year, as to how much supply enters the market from organisations breaking their contracts, and how many organisations also are willing to fix 10 to 15 year strips in a market that's heading north. Georgia, I don't know if you wanted to add anything there.
No, you've covered it perfectly.
Terrific. We've got a quick question, and I'll cover it off very briefly about a due diligence and about Thames process. I'll ask that person to come to us directly, and we can speak in great detail about Thames bespoke due diligence process. But I think some of the key things to point out is that due diligence is not just having a look at the verification reports or audit reports on a website. Due diligence has to go far deeper than that. And for us, typically, it's looking at things like ownership, human rights, and modern slavery issues associated with the projects. It's looking at benefit sharing on the ground, and also site proofing those with either checks from Thames team or our project partners. I will call out that there's been transactions certainly in the market that we've seen where organisations are saying, well, a client is asking for this particular price, so we've just gone and sourced them offsets from that at that price. Whereas if you have a look at the projects underneath, there's issues which we've red flagged. I think the broader point there to make is that there are varying levels of quality, let's say around offsets and carbon offset projects, and that going for the lowest cost and meeting a budget is not always the smartest nor the wisest thing to do when you're exposing your brand potentially to some adverse things that lie under the hood of that particular project. So it's got to go far deeper than what's publicly available. And again, I think that's where we've tried to emphasise in the clients that we work with, and our processes go to a significant level of depth underneath that. And as I said to that person, we can go into detail more on that, and for others as well. On our blog site, on our website, you can find a blog piece actually on due diligence, and that does go into the 4 or 5 key steps that we take there. I've got another quick question around, it's actually directed at SAF and the role of SAF with sustainable aviation fuel and what that will likely do for demand for offsets. I'm going to expand that question out more broadly to sort of flag the question of what about electrifications, alternative fuels and other technologies, and what role that's going to play. I think it's fair to say that in the case of sustainable aviation fuel, still you're looking at probably, despite all the investments, less than 1% of global fuel use using sustainable aviation fuel, and those dynamics may change, and they really need to change alongside of technology shifts into electrification and so on. However, we've got to realise that these technologies are going to take a long time, and even technologies across mining, infrastructure and other heavy emitting sectors, they are taking time. And in between that time, we mustn't forget that one of the key roles of carbon offsets is to address the emissions associated with doing business now. And the more that you do that, and the more that you price into the cost of doing business, the quicker that cost becomes real, and that the quicker the opportunity cost comes for a lot of these other alternative technologies which actually avoid or reduce the emissions in the first place. And so offsets can play that catalytic role in speeding up the transition towards sustainable aviation fuel and those other technologies. I would say also on that more broadly, things like the curves that you see from McKinsey and others with those predictions of 15 times growth in the next 7 years and 200 times growth out to 2050, they're all taking into account different technology mixes as well and accounting for that. So regardless of how quickly some of those technologies move forward, the key message is that the market is moving, and it's moving. It's going to move forward very fast, and therefore offsets need to play a critical role, no matter whether you're an airline or food and beverage manufacturer or anything in between. I just picking up a couple of questions here there, and Georgia, there is a question here about the ACCU price outlook for 2030, noting that there was the $75 price under the CCR that was flagged. Without getting your crystal ball out there, Georgia, I think it's fair to say that the general sentiment around the ACCU market is bullish. The spectrum of bullishness is wide, and it's probably just worth reinforcing some of those key upward and downward pressures that we're monitoring to be able to plant in the minds of our audience, just to, although not put a price expectation anywhere, suggest that prices are moving, and these are some of the key factors that need consideration.
That's right, Adrian. I think, yeah, it's an incredibly difficult task to be able to forecast that. It's certainly not something that I can do myself, but thinking about the demand signals that I spoke about, and that, there are much stronger factors that are influencing prices upwards than the factors that are influencing prices downwards. And that's for the short term as well as the long term. We think it's only a matter of time before ACCU prices do reach that $75 mark. Just to explain why the $75 is sort of thrown around there, that's the so I mentioned the cost containment reserve earlier, which would be a function of it would sit within the safeguard mechanism reforms, and there would be a pool of ACCUs that would be able to be accessed by safeguard compliance facilities, and those ACCUs would sit at a price of $75. Now, it's important to note that $75 in FY24, but increasing with CPI plus 2% each year out to 2030. It's really important to note that that pool, that cost containment reserve, would only be able to be accessed by safeguard compliance entities, not by the voluntary market. But there's been some discourse in the media over the last few weeks that effectively puts a cap on ACCU prices. I don't see that as the case because, as we know, Adrian, there is not going to be an unlimited volume of ACCUs that will sit within the reserve. In fact, we don't know where that volume will come from. So there, I suppose I haven't fully answered the question, but it's just to articulate that there are so many different factors influencing the price, but largely bullish as far as we can see.
Thanks, Georgia. There's two other key questions to address. One staying on the Aussie market, and then more broadly about how to navigate this complex world in terms of procurement strategies. There was one question around safeguard mechanism credits and the role that will play in terms of demand and demand for ACCUs. I think all I would say on that is that everything that we can see at the moment around how much of an impact safeguard mechanism credits will have on demand for ACCUs is very limited, certainly in the next few years. I think it's also important to note that if safeguard mechanism credits do play a role, that they're largely going to be held on to by the organisation creating them, and very limited opportunities to sort of to go outside of that. So Although it's a factor to watch, we've certainly heard from organisations that we work with and outside of the market that the expectations on how big of a role SMCs will play is fairly cautious at the moment, fairly minimal. There's a question here more broadly about how would you recommend companies approach the selection and purchases of offsets going forward, thinking about the risk of companies in selecting potentially lower quality international offsets. I think that first and foremost, I think working with an organisation that knows offsets in the offset market and has really sound due diligence processes is absolutely critical, and really making sure that you can lean on those organisations to be able to show that. As much as it's a lure to be able to chase lower cost offsets off computer screens, you do limit yourself to the amount of visibility that you've got on those particular projects. And as mentioned before, there's a lot sitting underneath the surface of carbon offset projects. I think what makes it helpful in that decision-making process is to understand where the business's appetite is for budget. A carbon offset can cost anywhere between $2-3 a tonne, right the way through to into the hundreds of dollars of tonnes, and being able to find out where your organisation's budget appetite is right up front helps you then be able to build out again a second strategy that we would strongly advocate is a portfolio approach. So it's very common that organisations in their use of offsets will have multiple projects in their procurement strategy. That helps to balance, the price risk. So, for example, a lot of Australian-based organisations have 10, 20, 30% of ACCUs and then the rest international to balance that cost. But it also helps you manage reputational risk as well, and supply risk as the dynamics maybe of some of those projects change. You can easily swap out of that portfolio and adjust without necessarily compromising the budget that you've got. So I think there are a couple of key considerations. I would also just note that price is a really bad indicator of quality. Often people come to us and use price as a proxy for quality, and it's just a false assumption. And again, not to spruce it too much, but we've got another blog article which addresses this issue. The price of an offset is dependent on where it is, how big it is, the standard that it uses, whether it's got co-benefits certified underneath it, and a whole range of other things. And you can pick up offsets that are, maybe sub $10 that actually have significantly larger environmental and community co-benefits than projects double or triple the price. So again, how do you navigate all of that? I think it's about making sure that you're working with a trusted organisation that's in the market day to day and has really sound due diligence, but also making sure that you've got a pretty clear in your mind what the company's appetite for is in terms of its budget. Georgia, I don't know if you wanted to add anything. I'm conscious we're butting up against time soon.
We are. No, I think it's funny that we're sort of, this is a great advertisement for all of our blog posts, Adrian. We better write some more. I just wanted to add there on that question around, how companies should approach the selection and purchase of offsets moving forward. I think it needs to be, there's no one size fits all approach, and it needs to be tailored to that individual organisation. So if you're really right at the start of your offsetting journey, I would be looking at what are the organisation's values, what's the organisation's sort of broader corporate strategy moving forward, and how do things like community benefits, environmental impact, etc., fit into that. Just to add that point, Adrian.
Yeah, absolutely. And I think, as I mentioned before, I think it's a great point, Georgia. A lot of organisations are starting to use their offsetting strategies to align with their nature commitments, reconciliation action plans, and other links back to traditional owner groups. So a lot of organisations, also more broadly, who have alignment with particular sustainable development goals, are looking for ways in which they can achieve those SDGs against their carbon procurement. I'm conscious of time, and we do have a bunch of other questions that have come up, and we will try and find a way in which we can answer those. But I just wanted to flag before we do leave an important development that we've got, and really the key message out of all of this is to highlight where we see some of the key market trends going forward into a market, whether it's here in Australia or internationally, is growing significantly. It's growing in complexity, it's growing in value, and there's need to be able to start to plan and take different strategies to your offset procurement. In view of that, TEM will have an opportunity that will go live in a week or so's time, around an opportunity to get involved in the carbon market, and that also includes an opportunity for organisations to participate in executive field site visits. We feel it's important that we get organisations who are purchasing offsets not only to look at them in terms of what's in front of them on the paper, but also getting them emerged in the market themselves and actually touching and feeling projects. So it brings that integrity and understanding of the importance of integrity in these investment decisions long term much more real, makes it much more real going forward. So we will go live with that in about a week's time. If that sounds of interest to any organisations looking to purchase offsets, I would encourage you to reach out to Georgia and I, either personally through the link to our emails in the Q&A, or jump onto our website, which also has more information on it. On that note, we are almost at time, and I will use that as a chance to thank everyone for the participation. The link will go up on our website to this video going forward. I encourage you, any follow-up questions, to please reach out directly and to share to anyone else this video if they have an interest in what's going to happen in 2023 and ways in which you can manage that. On behalf of Georgia and I, I'd like to say thank you and have a great day.